So if the market finally gets wise and realizes that we're not in a tech uptrend, and if we don't end up going back to those levels, we might see a much more broad sell-off because there's only so many other things that the market can manipulate to keep the indexes up. So again, you still have risk. If you're in the indexes, you're in the market. It's a lot simpler. So if the market crashed 50% and these indexes all went down 50%, and just because you have 10 different indexes doesn't mean if the market goes down 50, you're going to average only 40. You probably average 49 or 48 or 52 or 53 just by having different indexes. In 2000, when the market crashed, the S&P went down 51%, I think, or 53%. I think the Dow was 51 and the NASDAQ was over 80, 82 or 83. So you'd have been better off having just one of the indexes, and it would have been the Dow or the S&P that was a little bit more muted. Nevertheless, you still lost 50% of your money. And if you had mostly tech stocks, because those were the drivers of all the market, and those were where the dot-coms were, and they were so overhyped, everybody had to have them, that market fell 80%. So if you had $1 million in savings, now you've only got 200. If you're living on that money, it's not a good thing. So that's why I say, if you want all your money in a whole bunch of index funds, you're still at total risk for everything.